big focus this week on the consumer price index and the producer price index. The headline of your piece this week: will inflation stay tame? I think that you've got feelings about this.
I don't know. I want to put my feelings aside and just focus on what the data shows. And the data shows when you look at a consumer price index, well, it's been easing. I think we had in April, we were at 2.3%, just a hair above the 2% target. Producer prices actually fell. They didn't just ease. They didn't moderate. The growth rate didn't just slow. Producer prices actually fell in April. And so, there's a ton of disinflation. And then, of course, unfortunately, I think, the worry is that potentially this will be short-lived and that as the shelves get empty and, we don't get enough, we get this big tariff disruption, the price growth could actually accelerate. And I think that is the reason why the Fed has been sitting on the sideline, not cutting interest rates, further.
So, one of the other points that you had brought forward in your column this week was about just sort of savings behavior and the personal savings rate increasing by 0.6% from March to April. And looking back, the savings rate was just at like 3.5% in December. So, you present this, and I'll just read what you wrote for the benefit of the people who haven't yet had a chance to read your column. This isn't just a statistical curiosity. It's a powerful indicator that American households are pulling back on spending and preparing for potential income shocks.
Yeah. I mean, look, you're basically seeing textbook economics when people are worried about the future, when they're not sure whether or not, they'll have the same purchasing power in the future. They tend to pull back, and the consumer pullback is real. The personal savings rate jumped to 4.9%, the highest in the past year, the highest level we've seen in the past year, up from 3.5% in December. And so you're starting to see, households really pulling back and saving at a higher rate, partly because they expect, the economy to continue slow. People are worried. I mean, workforce confidence is ultra low, because hiring rates is so low. The number of, if you look at the labor market, and yes, we're still adding job at I would say somewhat normal pace or average pace. I would argue even slightly below average when you compare it to the pre-pandemic average. But the fact that businesses are hiring is basically on freeze across many sectors. The number of long-term unemployed is rising. The labor market is very weak under the surface. In the last jobs report we just got, half of the sectors reported by the BLS actually cut payrolls. Half. Right? So we're not talking about slowing. We're talking about cutting in half of the sectors. And so the labor market's slowing pretty rapidly. Yes, the unemployment rate is still roughly 4.2%, which is low, but it's going to rise. And I think that's what's going on. So of course, the cool down in the labor market, the cool down in small business confidence will be out this week, and the cool down in that as well. Small business are very pessimistic. I mean, you're having 18% of small businesses planned capital outlays in the next 6 months. That was the lowest reading for any April since April 2020 during the at the start of the COVID-19 pandemic. So, they're not planning to hire more workers. They're not planning to expand their operations. Yes. And then on top of that, if you're worried about inflation, housing inflation has come down significantly and continues to come down. So that's also going to be a drag on inflation. So in my opinion, I think the risk is more, on the biggest risk is of an economic slowdown than of runaway inflation. And so the Fed will meet next week, and I don't expect them to cut, but the signs are there that a cut is coming fairly soon.
Yeah, you also, in your column this week, you had an interesting little pullout near the bottom regarding profit margin compression. Can we talk about that a little bit? You had written, companies that try to maintain margins by raising prices risk losing market share to competitors willing to accept thinner margins. Well, that makes sense, right? I mean, competition is, that's what competition does. Those that don't raise their prices, those that don't raise prices see their profitability squeezed by higher input costs. So can we talk about this for a second? What are you seeing?
And the bottom line is this is not the middle of the pandemic where every household was getting checks from the federal government and people had excess savings. This is a moment in time where the excess savings have dried up. Demand is slowing. The labor market has slowed drastically, and people are just not going to be able to take those price increases. We're talking about tariffs. Well, most people will not be able to take that on, and I think businesses realize that, and that's why they're so pessimistic in the small business surveys. And it means basically an increase in input costs coming from tariffs will not necessarily be passed on, successfully passed on to consumers. And so businesses will have to do a couple things. Either they'll, I think what most businesses will probably do is actually try to protect their profit margins. And the way to protect the profit margins when you can't raise prices is to cut workers, unfortunately. Which is actually going to, add to the pressure on the labor market. So I expect the unemployment rate to rise to roughly 4.6%, in the second half of this year.
Well, I appreciate your thoughts as always, Dr. O.